Hello, everyone, and welcome back to the Direct Insurance Podcast, otherwise known as DIP, a podcast for independent insurance agents brought to you by Insurance Advisors Direct. I'm your host. My name is Kelsey. I am the digital marketing assistant as well as social media strategist here at IAD. And today I am joined by a very special guest, Chris DeMars of TruChoice Financial.
How's it going, Kelsey? Glad to be a part of the podcast today. Thanks for having me.
Thank you so much for joining me, Chris. I'm excited to have you. And so today we are going to be talking about Retirement 101 and different ways that our agents can help their clients save for retirement. And so this is what brokers might need to know in order to help educate their clients on why insurance products might be a better option for them in retaining their wealth and saving for retirement. So is there anything that you wanted to add before we get started?
No, I think, when it comes to retirement planning and using insurance, I think it was a really taboo subject back when I first got in the business back in 2005. And now fast forward to 2023, it's not so taboo. Matter of fact, it's one of the fastest growing segments of, let's just call financial planning, right? And all the things that are out there that independent advisors or insurance agents have access to or have heard of or clients have heard of and so forth. So it's definitely something that's shining light, I think, in our industry and really helping those folks who are nearing retirement or are already in retirement.
Yes, I agree. I think that it's something that's a bigger topic of conversation in today's world as well, because like we were actually just talking off air before we started recording, was that it's the cost of living and the cost of raising children has, tripled or quadrupled even in the last 30 or so years. So now we are sitting here thinking about, okay, so how are we going to save for retirement? What are the better options out there? And then, of course, in today's economic climate, where we're kind of now leading into a recession, it's going to be a lot harder for people in order to save for retirement because, most people these days are living paycheck to paycheck. So this would be a really, really great way for agents and brokers to be able to show their clients different means of saving for retirement and creating generational wealth. But actually, Chris, tell me a little bit more about you. Let's go ahead and give me your little elevator pitch, like who you are, what you do, and how what you do provides value.
Yeah, so I'm the vice president of advanced annuity sales. That's a fancy title for a financial wholesaler for an independent brokerage firm, TruChoice Financial Group. We work with independent brokers across the country, and everything we do is related to retirement planning using insurance vehicles. So all types of insurance vehicles, from annuities, life insurance, long-term care, hybrid products, and such. So we tend to stay more on the financial, I guess, kind of side of things, more so than the, like the med subs and all that kind of stuff, which I know is a focus of IAD. So that's kind of where, we stay in our little sandbox of annuities, life insurance, long-term care.
I do think that it is also very important that as an agent to be able to have a really, really robust and diverse product portfolio, because not only is it going to help you as an agent or a broker to be able to have a larger book of business in the sense of that when you are able to offer more products to your consumers and to your clients, not only are they going to stay with you longer because not only did you sell them their Medicare plan, but you are also helping them save for retirement. You're also helping them with their life insurance as well. It is something that is just going to create more benefits for you as an agent or a broker in the long run, because it's going to help with loyalty and retention as long as you have a good CRM system.
Yeah, absolutely. I couldn't agree with you more. People want to be more efficient nowadays. Speaking of retirement, once they get to retirement, they want to be doing the things that they've been saving for retirement. And I think that's maybe a topic that we're going to discuss is why do people save for retirement, right? Well, they want to spend time with their kids, their grandkids. They want to take, those vacations they talked about. They want to retire to their lake home or, do all these things. So if they can only meet with one financial professional who might be fully licensed and able to do everything and be a one-stop shop, that's a huge value to you as a financial professional, right? So whether your securities license with a broker dealer or you just have your Series 65, you got your life and health, you've got, all those licenses that you can offer everything from securities all the way down to, med supplement, even health insurance or disability plans. I mean, who wouldn't want that as their financial professional?
Exactly. Right. Yeah. It makes it so much easier for someone as a client to be able to be like, okay, if I have an issue with this, I know who to call. If I have an issue with this, I know who to call. But
Yeah.
if all of your issues can be solved by one person, it makes it a lot easier for you to remember that phone number.
Exactly, exactly. And for the financial professional, obviously that creates a lot of stickiness, right? So they're less likely to jump ship for the next advisor who's looking for their next best client, right? I always tell my top financial professionals that I work with is like, hey, listen, if you're not doing the things to keep that client here, your best clients are another advisor, another broker's best leads.
Yeah,
So,
exactly.
you got to be doing, more than just sell them what they need now. It's all about continuing to foster that relationship and doing all the things to keep them in the business and in your block of business and as a client.
Yes, exactly. But yeah,
Yep.
so let's go ahead and jump into our first question here that I have for you, which is why do consumers save for retirement? I know you had kind of touched on this a little bit earlier with like maybe people want to travel, maybe they want to retire to a lake home, but what are some other reasons as to why it's so important for people to save for retirement?
Well, the at the crux of the issue is right, once you retire, you no longer have a paycheck coming in, right? People have worked 30, 40, 50 years of their life, and they're so used to having that paycheck come in every 2 weeks or twice a month or whatever the deal is. And all of a sudden, you're going to tell them one day once they retire, they don't get that anymore. Well, how is that going to be replaced? Yes, you do have Social Security, but right now, Social Security on average is only intended to replace, or what the numbers show, it replaces about 37% of an individual's income. 37%. So if you do the
Yeah.
simple math on that, on $100,000, if that's what you're used to making for the last 20 years, you're only getting $37,000 now. Now, for some, that might work out. That might be all they need. Their house is paid off, everything, their cars, whatever. Maybe they just have to pay the taxes on their house and the electricity bills, the cable, some of those things, and that might be fine. But I'm going to tell you, probably for the average person out there, that's not going to cut it, right? So now where do you go to? Well, your savings, right? Because pension plans, for the most part, unless you work for the government, don't exist because corporations got smart and it's a cost savings to them instead of providing a pension plan because they have shareholders to appease, is that they went to defined contribution plans. So they shifted the onus from the employer to the employee with 403Bs and 401Ks as a source and a way to save towards retirement. So now you, as the individual, are the one who's really in charge of your retirement because let's just face it, Social Security is not going to cut it. And I threw out that number of replacing 37%. I think I've also heard something that's probably lower than that for most people. It's probably going to be about 25%. So, we have to find other sources of ways that we can provide income. And that's going to be through personal savings, 401k or 403b, whatever that looks like for you. You just have to save because there's going to come a time where you're going to want to retire, as I mentioned, because you want to spend more time at your lake home or you want to spend more time with the grandkids. You want to take the trips that you've planned about your entire life with your significant other. You want to do this, you want to do that. The fact is that when you retire, every day is a Saturday.
Yep, exactly. I was going to say that one of the points that I wanted to even bring up too is that as we've kind of mentioned before, that the cost of living is going up. So
Mm-hmm.
what does that mean for someone who is maybe like, we'll say for me, example, I just turned 31. So for me, the cost of living now is already pretty expensive, but in the sense of that, what's that going to look like in another 30, 40 years, when I'm planning on retiring? How much is life going to cost in order for me to retire to my lake home? It might not be so grand of a drastic difference for somebody who's maybe already like in their late 50s, early 60s, and now they're kind of going into retirement. But our agents and brokers, what does that look like for their clients that are, maybe in their late 20s, early 30s, maybe sometimes even your early 40s? It can be kind of terrifying to think about all of the things that are kind of going up in cost. Your kids' college education. I mean, I went to the University of Michigan Dearborn, which in general, because it's a commuter college,
Mm-hmm.
was a little bit less expensive than going to like U of M Ann Arbor, but it was still expensive. I mean, like I still paid a good like $8,000-9,000 a semester. So what's that going to look like in another 10 years, 20 years. So when you have these people that are trying to save for retirement, but they're also trying to help out their kids with their college education because you don't want them to have to pay for student loans and then bankrupt themselves for the rest of their lives, and because that in and of itself is an issue. So, how are we kind of getting into this mindset or helping our agents get into the mindset of these are going to be the best ways for you to be able to save for retirement, help your kids with their college education, and I guess like a retirement plan and a savings plan that is going to be more effective and safer than putting your money in the bank.
Yeah, absolutely. I mean, when I first started this business in this industry, I should say, in 2005, there was a study done by the actual insurance carrier I worked with at that time, and the polls showed of the people that were asked to be a part of the study. I think it was 40 to age 75, and they said, how much do you think you need for retirement? And I think the average response, if I remember correctly, was like $500,000. They thought that's what you had to save, and so this is back in 2005, and back then it was roughly about 1.1 million, I think, was the nest egg that you needed to have a secure retirement. And that was based on annuity payout rates at the time and whatnot. And let's just say on $1 million, if we use a nice round even number, and you can get a guaranteed 4% payout, I mean, that's going to only give you $40,000 of income a year. So again, if you get Social Security, that's going to provide 37% of what your desired income is, and you're making $100,000 a year, and you save $1 million, then you got 37,000 coming from Social Security, and you have, if you save that $1 million and you get a 4% guaranteed income, that's 40,000. So you're looking at 77,000. You're still short of your $100,000 that you're used to taking home every single year, right? So this is back in 2005. So I don't know what the number is today per se that you would need as like a comfortable nest egg, but I can say because of the rising cost of everything and inflation, I don't know where the CPIU ended last year, but which doesn't even take into account energy, but I think it was somewhere where I think it ended around 8%, let's just say. So thinking about those things, I mean, that number is significantly higher in 2023.
Yeah. And when you said that, the average person even back in 2005 would need to save $1.1 million in order to, have that as like a comfortable way for retirement. Immediately what popped up into my head was, gosh, like even if you didn't spend a penny of what you made and you made $100,000 a year, I mean, it would still take you 10 years to save that much money for retirement. So we have to think about now what's going to be a more effective way to save for retirement in a shorter period of time. I mean, if you're making $100,000 a year and you're only putting away, let's just say even 10, 20%, $1 million, divided by $20,000 a year, how long is that going to take you
Yeah,
to get to
20
that number?
years.
And that was 20 years ago.
Yeah.
So there are several different retirement options that are available to consumers in today's world. Let's kind of go through those kind of one by one and dive a little bit deeper into those options. Let's go ahead and start with accumulation annuities. Let's go ahead and go through that one.
Yeah, sure. So accumulation annuity is, let's more generally speaking, just a traditional fixed annuity. Not as popular in today's marketplace, being that we were in a very low interest rate environment up until the last couple of years. And so those haven't been as popular because they're interest rate sensitive. So usually a company will give you maybe a guarantee of 1, 3, or 5 years, and it might be on a 5, 7, or 10-year chassis. And then whatever that guarantee runs out, then whatever. So let's, for example, let's probably a 7 years is the most popular. So they may give you a 1 and a 3-year guarantee option, and then after that 1-year guarantee or that 3-year guarantee, then you're up to whatever the interest rate renewal is for the remaining 6 or 4 years. And so people didn't want to take on that risk because it, especially in a lower interest rate environment, the 1 year might be a really attractive rate, but darn well in a low interest rate environment, the renewals from years 2 through 7 might not be that great. So it's a little bit of roll of the dice. Haven't been much popular. I think in my entire career, I've sold maybe a couple of those. So, and that's just your traditional annuity, which I think leads then into guaranteed annuities or guaranteed income annuities. So that is also something, depending on the situation, aren't as popular. We do write a decent amount of them, they're very rigid and they're irrevocable, I should say. And that's where the rigidity, if that's a word, rigidness comes from, being that once you put your money in and you set the terms, that's that. You can't switch the terms, you can't surrender the policy or anything like that. But being that they're straight annuitization style products, they tend to have a little bit higher benefit or higher payout because of that. So there's always, give and take with anything, right? And especially in finance. So that's kind of the give and take. And so like a SPIA is a single premium immediate annuity. You put a sum of money in, and that's going to guarantee to pay out based on whatever terms that you have selected. So if you want to just do life only, or a life in 10 certain, or life in period certain 10 years, or just you can do a straight 10-year certain or 15-year certain. You could do a life with cash refund. You can do joint life with any of those options. So there's a lot of different options on how you can build your payout. But again, once you set that ball in motion, there's no turning back. It's set.
Yeah, so that might be kind of like one of those caveats, is that if your needs ever do change, it's kind of hard to fix it. But let's go ahead and next talk about fixed index annuities with the option for income riders or benefits.
So that is where we see, bar none, the majority of assets and premium going to is fixed indexed annuities. That has kind of been the bright light in the annuity realm of the world, where back in 2005 it was still kind of, people would say, a four-letter word. But now with the work of different associations and the education that companies like myself and you guys there at IAD have helped educating the benefits of indexed annuities and so forth. They keep on setting records. Last year was another record-setting year. Already first quarter of this year, I think we're up 23% over last year, and they just become more and more popular as people realize the benefits to these. And because there's been an uphill battle on some of the misnomers on these, on how they work, and the annuities of what we call our your father's days or your grandfather's days, where you put the money in and God forbid you die, then the insurance company keeps it. That was like the biggest misconception on annuities. It's like, that's not how
Yeah,
that
like
works.
it
So
doesn't work like that.
yeah, it doesn't work like that. So index annuities are interesting because they use a form of an index as a barometer to how you can grow your money. You get the benefits of, protecting your principal. So all these products that you mentioned to start this, all your money is protected. Your principal is protected. Nothing is at risk. You can't lose your money because of any kind of stock market fluctuations or what have you. So the indexed annuity is kind of that happy medium between, your traditional fixed, your guaranteed income, or even getting into, I know you mentioned multi-year guarantee annuities, which I think we're going to discuss as well, which all those are even more on the conservative side. So it's the indexed annuity is kind of your sweet happy medium between, if you wanted to go on the more riskier side of things, on the pendulum being all your stock market tied products, if you will, to everything in the annuities. So with the index annuity, as I mentioned, being the happy medium, you have the ability to choose different indices on how to grow your money. Usually that's limited or controlled by like a cap or a par rate or a spread, if you will, and we can touch on those if you'd like, but not to get too deep in the weeds. And then of course your principal is protected, so you can't lose any money. So that's why they have some kind of control mechanism on the growth side, so you can participate in a little bit of that indice growth without having to actually directly invest in it and being subject to potentially losing money on a down year. And then in addition to that, that's where you have options, rider options to choose, whether it's an income rider option or a death benefit rider option. There's other features and benefits that involve long-term care, like terminal illness, or long-term care benefit. So there's different ways that you can get out of these products, because all annuities are subject to some sort of terms, and we call them usually surrender terms or surrender schedules, and they have surrender penalties that you can get all these benefits like tax deferral. Some will even have bonuses, the income riders, guaranteed income for life, all these benefits that come along with annuities somehow have to be protected, and by the insurance company, they need to protect themselves. So they also come with surrender schedules, which have usually a decreasing surrender penalty period.
One of the things that I was thinking about when you were talking about the benefits of the fixed indexed annuity and just with like the benefits, including like the income riders, was that when we're talking about market volatility, in the sense of that most people, when they start off with a new business or if they get a job with a new company, the first thing they think of is like, okay, what are the benefits? So 401k contributing, does the company match what you're making or match what you're contributing to the account? I'm sorry. So in my opinion, everybody should have a 401k if it's offered by their company, because it's a great way for you
Mhm.
to save for retirement. But another option to have on top of your 401k would be a fixed index annuity, because you get all of the benefits of the 401k without any of the caveats, in the sense of that if there is a market dip, you don't lose any money. With 401k,
Yeah.
like if the market dips, like you're going to lose money. My mom is
Mhm.
so upset because like she's lost so much money out of her 401k since the market's been like in the tank right now. So I was just like, well, if you'd had a fixed indexed annuity, like we wouldn't really be having this problem. Your money might not grow with, any, market interest, but you're also not going to lose any of that money either.
Yep. And so, which brings up a key feature of an index annuity is the benefit of having an annual reset.
Yeah.
And so we look at things typically in 1 year terms, and 2 year terms are probably the most prevalent in indexed annuity contracts and products. And so when we look at the terms of like a 1 year point to point, let's say today, this is June 2nd, right? So if we issued a contract today and our anniversary date is June, well, it would be June 2nd of 2024, but they're going to close that indice as of June 1st, 2024. And then they're going to calculate, okay, did that index, was it positive? And let's say it was positive, 12%, right? And you got a cap of 10. Okay, so you're not going to get the full 12, you're going to be capped at 10. So you get 10 credited to your policy. If, like, let's say the following year, you get that 10 credited. So now that's the 1 year point to point, that's locked in. So if you had $100,000 in a contract and you got 10% return, now you have $110,000 in your contract. Now we're going to start fresh the next year. And let's say the next year was a bad year. It was down, it was negative. That indice lost 20%. Okay, well, you get a big zero. And then you start over scratch now at the beginning of your third year. So that annual reset feature is a very key feature because it always locks in and protects whatever your gain is. And a great analogy, it's like a ratchet. It can only go up, it can't come back down. And that is, I think, one key feature of an indexed annuity that doesn't get highlighted enough, because that is the engine of an indexed annuity, is that you get to lock in your gains, you get to keep them tax deferred, so you're not paying taxes each and every year, and you can defer those until you need that asset, whether in the form of a guaranteed income source of money or a lump sum or whatever. And then, of course, at that time, when you take receivership of that asset, then it'll be taxed accordingly.
Actually, so one of my questions, this isn't even something that I had planned, but this was something that I just thought of, was that, so say for example that you are in the annuitant phase where you are receiving the annuity distributions after you've retired. Are you able to put that money? So say for example, if you are receiving, let's just say, let's throw out a number out there, say $3,000 a month is what you are, as an individual getting from your annuity payments. Can you put $1,000 back into that account and then have it continue to grow?
No.
Okay.
So once you've exercised your ability to start income, whether in the form of a systematic withdrawal payments guaranteed for life, which is what like a lifetime income benefit rider, an LIBR, would do, or in the case of a SPIA, a single premium immediate annuity, those guaranteed income annuities that we touched on, once you've either annuitized your SPIA or you've started taking income for life on your FIA with an income rider, now you are in the income stage of that. So once that has been exercised, you cannot continue contributing to that policy. Now, from there, if you didn't need all $3,000 a month, by all means, you could maybe take that 1,000 that you didn't need, the 2,000 to pay your bills or do whatever, and then additional 1,000, you can maybe put that into another annuity if they had flexible contribution opportunity. There's only a handful that exist in the business today that will take flex contributions of the contract, and which also then touches on another key feature of annuities. Usually there's a limit or a minimum to actually start a contract. Typical average is usually about $10,000 in the business. So on your 1,000, wouldn't quite get you into opening up a contract. But if you save for a year, you could then start a contract at the end of that year, and then going forward, put that $1,000 in it year over year. If you were to do that, I don't see that happen. I don't think ever, but it's a possibility.
Okay. Well, I mean, that I think that kind of just shows the flexibility and some of the other benefits of annuities and how they can be so flexible and used in different ways. But
Yeah.
since we've touched a little bit on the MYGAs, the multi-year guaranteed annuities, let's go ahead and jump into those.
Yes, sure. So I like to tend to think of these, and most people can wrap their head around these as almost like a bank CD alternative. So it is an annuity issued by an insurance carrier, but it gives you a guaranteed rate for that term. So right now, probably the most prevalent is going to be a 5-year option. So, some of the top rates are going to be five, a little bit over five, five and a quarter, up to 5.4, guaranteed rate of return each and every year for 5 years. And then at the end of that 5 years, you can go ahead and walk. And now what's so beneficial about a multi-year guarantee annuity is that it's tax deferred, and most of them will have some type of withdrawal feature, whether you can take the interest that you've earned off the top and keep your principal at bay, or you can take more than that. Some will allow maybe even a 5% or even up to a 10% free withdrawal if you should run into a jam. But otherwise, yeah, you're going to get that guaranteed interest rate for that term, and that's that. And most of them are short term. And with today's interest rate environment, the interest rates on shorter term, the risk-free treasury rates are much better on short-term rates than they are long-term. So we're seeing more people, more financial professionals use like the 3 and the 5-year MIGAs today.
Awesome. Let's go ahead and dip into long-term care insurance with hybrid options.
Yeah, so so when I first got in the business back in 2005, the individual LTCI policies were pretty popular, but unfortunately, most insurance carriers couldn't sustain the rates and the premium rates on those policies. And so over the course of probably that next 10 years, 2005 to 2015, or probably even sooner than that, I mean, there was a rate hikes across all policies. It didn't matter. I don't think there's anybody that was immune to that. All insurance carriers did, because they realized how expensive it was. And then it just got to the point where now, looking at today, buying an individual LTCI policy and being able to afford the premiums on that just seems daunting. And so what carriers have done have really gotten innovative and creative on how we could still be able to provide a significant long-term care benefit to those folks who may need them. I don't know the stats on how many people will need long-term care, but it's a very high number. And so what these LTCI policies essentially are is they're asset based. So instead of having to fork over, $5, $6, $7, $800 a month to sustain a long-term care policy that might give you, I don't know, $300 a day, or maybe what is it, $300 a month benefit, or whatever the benefit is for X amount of years, it's just most people aren't willing to pay that. But what they can, and long-term care insurance is also pure insurance. So meaning like car insurance or homeowners insurance, like if your house doesn't burn down ever in your life, well, you just paid all this insurance, and you're not going to get that money back. The insurance carriers are like, oh, hey, yeah, you did great, you didn't burn down your house, let me refund you all your premiums. No. So
Yeah,
same with
no.
long-term care, right? That's the same way. So that was also the other big rub against long-term care, is that you're not going to get your money back. Where now in the long-term care hybrid policies, they're built actually on life insurance chassis, typically whole life insurance chassis. So you get a death benefit. God forbid you don't use it, so you don't technically lose that asset. So again, it's asset based. So you put $100,000 into one of these policies. They may say, based on your age and health conditions and all that kind of stuff, so they're fully underwritten, that put $100,000 in. You may have a $200,000 death benefit, or maybe even more, but then they're going to give you, 4% of whatever you put in as a monthly long-term care benefit. So you put $100,000 in, 4%, you're going to get a $4,000 monthly long-term care benefit that you can use until you obviously exhaust your funds, right? So now they've gotten, it's much creative. much more creative, and provides a benefit that it's not pure insurance. And most of them have an ROP feature. So if you already had significant life insurance in place, and so the play here wasn't maybe life insurance, it was more for the LTC protection. And let's say you go and you're in your mid 80s, which most people are going to need it probably the early to mid 80s if they're going to ever need it at all. And let's say you're in your mid 80s and you're just still kicking along and healthy as can be, and you're like, you know what, I don't think I'm going to need it. Most of these are going to provide a ROP feature. So if you put $100,000 in, you can get your $100,000 out at any time.
Yeah, that's a really, really cool feature too, because my grandparents had paid into a long-term care insurance just in case, because they my grandpa knew for sure that he never would want to like move out of the house and like end up passing in a nursing home. That was something he definitely didn't want. But they knew that they had still paid into this long-term care insurance because you don't actually know. They don't know if you're
Yeah.
ever going to need it. It's one of those things that you should have because it's like the oopsie daisy money. But
Yeah,
it
for
it is really
sure.
cool that
Peace
you
of
do get
mind.
the death. Yes, exactly.
Right.
So it gives you that peace of mind, but in the sense of that if you have the hybrid option that does have that death benefit, then it's like, okay, cool. So even if you never needed the long-term care, at least you had the life insurance side of it. So
Yeah.
then that covers the costs of the funeral, which in and of itself is extraordinarily expensive. I mean, most funerals on average, even if you have like one day of visitation and then, you have your memorial or service ceremony, whatever the case may be, the average is about $15,000 right now. And that can be a big chunk of change for a lot of people. Not everybody just has $15,000 lying around. That's the reason why I see a lot of GoFundMe's. So
Yeah.
let's actually talk about life insurance and using that as an option for savings for retirement.
Yeah, absolutely. So on the life insurance side, so just full disclosure, I am a whole annuity wholesaler. So I'll be very high level with this life insurance conversation, but I think it's enough to get a fair gist of it. So when we talk about life insurance for retirement planning, we're usually focused more on index universal life, or what people might call cash value life insurance policies that are going to build some type of cash value that you can use to supplement your income in retirement. And why index universal life has become so popular is because you get that indexing, so you get the opportunity to earn more on your money that is going to bolster up your cash value in your policy, and then you of course get the death benefit as well. So God forbid, you get life insurance for really, one main reason, and that's dying too young, right? To help your survivors, your surviving spouse, your children, or whatever, be able to continue to move along without any hardships. But now with the innovation in the industry, we've got policies like IUL policies, and even there's some whole life that builds some cash value. But I think at the center of when it comes to actually retirement planning, using income to supplement your retirement, IUL is going to be the flagship product on the life insurance side. And it's been grandfathered in under, I couldn't tell you what IRS code, that when you take income from the cash value of a life insurance policy, it's tax free.
Oh, yeah, that is a great benefit.
So if you think about like life insurance as a whole, I mean, the tax benefits of life insurance are remarkable. So whether you're using, income from your cash value to supplement your retirement, that's tax free. Whether you die to pass that death benefit to your beneficiaries is tax free. So a lot of different ways that you can use life insurance that are tax favorable.
Yeah. That's great. Yeah. I'm sitting here like dumbfounded for words because
Yeah.
this was something that, a lot of people don't really even think about when they think about saving for retirement. They're like, "Oh, well, why in the world would I have like a life insurance policy? Isn't that only for, if I pass away?" Like that doesn't make any sense. But the more that we are learning about the benefits of using life insurance in the form of like an IUL or even using annuities to save for retirement, it makes so much more sense than simply just having a 401k or just having a savings account, because your growth opportunities within these different insurance products are exponential in comparison to more traditional forms of saving for retirement. So one of the more traditional forms of saving for retirement would be a bank CD. So let's go ahead and dip into that.
Yeah, well, yeah, I think everybody knows about a bank CD. So there's not a whole lot to discuss here. You're going to get your basic interest rate. It's not tax deferred. So just think about that. You always have to discount whatever your percentage rate is. right? Because with your taxes. So there's always that caveat. And I think why bank CDs are still popular and why people even still use them, when they could otherwise just go to insurance carrier and get a multi-year guarantee annuity that we discussed and get probably a better rate and get more liquidity and more control of that asset, is that they feel comfortable. They can walk
Mhm.
down the street to their local bank and they know the teller there and all of those things, right? That particular client likes, and they want to do business with the people that they've been banking with or what have you. So of course, that's why people use a bank CD. Now, I will say this, because of interest rates right now and how high short-term interest rates are in the risk-free rate. I mean, I tell you, I think you can get. We're just talking with other colleagues of mine, and you can get like a 10-month or a 9-month or 12-month, whatever bank CD rates up into like the mid fives or upper 5%, which it sounds great, right? You're like, oh my God, I can get, I don't know, 5.5, 6% on a 10-month CD. That's perfect. You're going to pay now taxes once you get out of that CD at the end of the 10 months. And then what are you going to do? Are interest rates going to still stay strong in the next 10 months? Not from what I'm hearing. They could,
Yeah.
though. I don't know. I don't have a crystal ball. Nobody has a crystal ball. Warren Buffett doesn't have a crystal ball. None of us have crystal balls. I don't know where interest rates are going to go, if they're going to start to suppress them. We know we got an election here next year. All those things play a part in, how the feds are going to set rates and so forth. So there's a lot at play. From what I'm indicating is that rates will probably may come back down. So if that's the case, I don't know when that's going to happen, but now you've introduced yourself to interest rate and renewal risk,
Yeah.
which is a form of risk, right? Yeah, it's great. Like, go get that, I don't know, I'll just say 6% 10-month CD rate, but is that better than a 5-year 5.25%?
Yeah.
That you're
It's
locked in now for 5 years at 5.25%? I would say the latter is probably better. But for each their own. That's why we live in a free market society, and people are going to vote using their dollars on what they want to use, and so they just have to weigh the risk and the rewards and go from there.
Yes, I'm actually really glad that you brought up that we vote with our dollars because I think that there's a lot of shift in today's world in the types of businesses that we support. There is a huge push for shopping with small businesses because there are lots of benefits to shopping, with a small business. Because number one, because that small business they pay local taxes, which therefore goes into helping the community, goes to pays to support schools and supports public
Different
services and things like
causes.
that. Yeah, exactly. So
Mhm.
there's lots of different benefits to shopping small. And so there are so many people that are pushing for not shopping with. I'm a huge person that likes to shop secondhand because number one, I absolutely despise the fast fashion industry because it just creates so much waste and it drives me absolutely batty. So when I see a small like boutique that is, selling things that are kind of like a one of a kind type thing, that's a small business that I wanna support because they're not just, like, mass producing a bunch of stuff that's gonna be out of style in the next, like, 2 years. It's like that type of stuff doesn't intrigue me. So, shopping secondhand or shopping small and supporting a small business is really what is going to help propel us, into the future because granted, yeah, like, everybody is so convenienced with Amazon, but, shopping with Amazon all the time is not sustainable for our communities at large. But I did like the fact that I kinda wanna go back to what you were talking about with risk, which was going to be my next question. So, what are the risks that are associated with retirement?
So there are many risks that once you quit your job and every day becomes a Saturday, start to then creep into the equation. There is longevity risk, there is sequence of return risk, there's withdrawal rate risk, there's tax risk, there's healthcare risk, and I think I'm missing a risk, but those are tend to be, I think I covered most of them, but those are, I think, the significant risks. And leading with longevity risk, right? The longer you live, which people are starting to live longer, right? I think if you have the stat as of today, or at least last year, I should say, was if you have a healthy married couple in their mid 60s, so 65, there's a 92% chance one of them's going to live into their 90s. So we have longevity risk. And so the longer you live, right, your money has more is at more at risk for one of those things happening. For instance, withdrawal rate risk. The longer you live, the more you have to withdraw. So if your nest egg isn't big enough, withdrawal rate risk becomes a problem. Sequence of return risk, which is essentially the money that you have in the market is subject to sequence of return risk because you're introducing return risk, which if you're at a loss, if your account's down and you need to pull money out to live, right? Just because your account's down doesn't mean your electricity bill goes away or your mortgage payment goes away, right? It doesn't. So now there's sequence of return risk. There's tax risk. We're at 20 something trillion dollars in country debt right now. The only way to get out of that is if we tax more. I don't care if you're a Democrat or a Republican. It has nothing to do with that. It's called math.
Yeah.
It's simple math. Like, so if taxes go up, that affects your money and how you take income, right? So there's tax risk, healthcare risk. I mean, obviously, the longer you live, there's more risk that you're going to get a disease or your health is going to fail you or whatever, right? So longevity is a risk multiplier. The longer you live, the more one of those risks is going to affect you. If everybody retired and said, hey, I know I'm going to die December 22nd, 2062. Well, everybody knew their death date, then retirement isn't a problem, right? Everybody would know how to retire. They know the exact dollar amount they need, all this stuff. That's just not it. That's fantasy world, right? So we don't know those things, and therefore that's why we have to save for retirement and do whatever at all costs to minimize those risks that I mentioned. And really, the only way I know how, and I've been securities licensed in the past and I know everything. I've been in the business 18 years. The only thing that can mitigate all those risks is an indexed annuity or some form of an annuity, because you can't get a guaranteed income source from anything in the world other than an annuity or your social security. 401k doesn't do it, a stock doesn't do it, a bond doesn't do it, a mutual fund doesn't do it, your bank account down at your local bank doesn't do it, a bank CD doesn't do it, a multi-year guarantee annuity doesn't do that, even fixed annuity doesn't do that. It's just a guaranteed income annuity like a SPIA or a DIA, or an indexed annuity with some sort of income rider. That's it. That's all there is to it.
I guess we'll go ahead and pop into my next question here, which is, so if you were an independent broker that was kind of just like out here in the streets, out in the field today, how would you position an annuity as an attractive option for retirement to your consumers?
Wow, there's so many ways to go about this, but I think generally speaking is that keep one thing in mind, right? This isn't the best thing since sliced bread or the greatest innovation or whatnot, so it needs to be used accordingly, right? And an annuity isn't going to be for every single dollar of your client's nest egg, right? They're here. It's a tool to use amongst many tools that financial professionals have access to. So for a certain subset of a client's assets, it can be a great advantage for them to be used, whether A, as a guaranteed source of income to supplement what they already have coming in. And if they only have maybe Social Security, that's usually what everybody can count on, right? Some may have a Social Security and a pension. Some may just have a pension. So there's always something that needs to be supplemented for the most part. There's of course a lot of clients who've done really well and they're going to have a great Social Security income and they may have a pension and they may have a couple of rental properties that provides income. Maybe they're all set and they don't need an indexed annuity or an annuity with some sort of guaranteed income rider feature, right? That they can't outlive. I don't think I've really stressed that, is that these income riders are guaranteed for life, so they can't outlive them. So that's how we mitigate all those risks that I mentioned before. But so maybe an annuity is just a play because most people want, when they age into retirement, they get less risk adverse, right? They've witnessed all the ups and downs from whatever investment vehicles that they've used to get them to where they are now. And now maybe they're a little bit less risk adverse. So maybe they want to protect a portion of that asset. Not all of it, because again, not every dollar can go into an annuity. There are suitability standards that each insurance company abides by. So they wouldn't even allow you to do that in the first place. But let's say there's a certain number, whatever that number is, of that the client's nest egg that you want to put here to protect, maybe get a little bit of growth. You can use it as kind of a quote unquote, what we would say, a hedge against the overall portfolio. So at least that portion of that portfolio is completely protected, which may allow them to be a little bit more risky with some of their other stuff because they know, like, hey, this is safe. Can't lose any money here. I'm going to make a little bit of money and we'll figure out what to do with this asset down the road. Or, there's different benefits. Each carrier has different products that might be a benefit for this situation or that whatever. So I hope I touched on your question. So I think which was, what are the benefits for somebody who's listening to this? Like, why would they want to use an annuity, right?
It would be more of as an agent or a broker, how could
Yeah.
you position an annuity product as an attractive option as for a means of retirement, which I think you did touch on as well. And I think that we've kind of like touched on a little bit more even throughout the entirety of this podcast here is that there are so many other more traditional things like bank CDs that people are really comfortable with. They know that they're locked into a certain rate, or they think that they're locked into a certain rate, and that they think that they're going to get a nice return on it. But an annuity product, in my opinion, is so much more attractive because I mean, how many times have we seen the banks get bailed out? People are, the banks are lending out all this money, and then next thing we get into another issue like we did back in 2008, 2009. And so now, like, what's a safer way for us to save for retirement? What's a safer way for us to put away our money without having to lose it all due to the negligent acts of people that don't deserve to have our money? you know um
Yeah. Yeah, you bring up a really good point, and one that is very timely due to some of those banks in Silicon Valley that have failed. And so that has that at that time that happened. Now it's a few months back, but at that time that circulated the question of what you just said. Okay, why if I can't trust my bank? Everybody thinks that they can trust the bank because it's the federal government and da 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 da. I mean, how
no.
many times has the federal government failed us? And this is just another shining example. And it's like the insurance companies usually have well, they do have by law a reserve requirement, but to get a high rating by a rating agency like the S&P or AM Best or Fitch or whoever, right? S&Ps and AM Best are kind of the standard. And to get an A or an A plus rating, it's all based on your reserves and the assets that you have in your general account. So the A plus carrier rated, A rated carrier companies, excuse me, they tend to be higher on the reserve side, and they get up to, some of them might be even for every dollar put in, they have maybe $2.72 in reserves. So they are well positioned to not fail based on the reserves and the requirements that they by law have to have on hand. And the other thing too that I like to point out is with an insurance carrier, they're on both sides of the equation. So even if the US stock market, we go into another Great Depression, right? Or what was called the Great Recession, even 2008, 2009, not one of the carriers that we do business with failed.
Yeah.
Not one, not one went under, because they're leveraged on the other side of the equation, which is the life insurance. So they're on both sides of living too long and dying too early. So they're getting premiums on both sides, which helps smooth out any market condition for an insurance carrier. And I think we tend to overlook that, or that's something that a client or a consumer wouldn't think of. And for that matter, even a lot of brokers may not be thinking that way too. So, insurance carriers are well leveraged, have plenty of reserves. So I think the true testament was, the Great Recession of 2008, 2009. There's not one insurance carrier that went under.
And that actually, I think, is kind of what leads me into my next question is why the insurance products are becoming more popular options for retirement in today's world. And I think that's exactly what we just touched on is the fact that it's a more reliable option. You know,
Yeah.
we don't need to bail out the insurance companies. We've had to bail out how many banks, so it's becoming more attractive to people because they are becoming more educated on the features and the benefits of the insurance products. And they're in some of these options like the fixed indexed annuities and the IULs, it's like there's all these benefits, but not a whole lot of caveats. So it just seems to me like these options are becoming more popular because they are more attractive to people because there is so much more flexibility and they get so much more out of it.
Yeah, well, I think there's a couple reasons why they're becoming so popular. I think first and foremost, back when, indexed annuities first hit the scene in the late 80s, kind of early 90s, if you will. Back then, it was people, I guess, kind of refer to it as the wild, wild west of insurance. And usually they were only sold by quote unquote insurance agents. And that back then you had the seller's mentality of, they're salesmen, and so they want to sell as much as possible. And so I think that they were used improperly and being sold as, hey, put all your assets in here. And back then there was no suitability standards. I mean, it wasn't a big business, so there wasn't a lot of regulation, right? But as any business grows, more regulation, and the tides have shifted where now most people who are selling insurance were the people who kind of hated it until they were educated, which was securities license folks. And now I would say when I got in the business, most of my production came from insurance licensed only financial professionals. And I would say now I would probably say only 25% and 75% comes from securities license folk, which again ties back all the way into the beginning of our conversation of that one stop shop.
Yep.
And so if you're able to offer, securities based products, insurance based products, health based products, so on and so forth, I mean, what a convenience. And now that stickiness of having that client that for life, instead of being just, one spoke in the wheel, and now you have six financial professionals that this consumer has to deal with. So I think that tide has changed. And I think just overall education, the amount of money that's been poured into different nonprofit organizations who really have no skin in the game. They're not insurance carriers. They're not making money off of this type of stuff, who've helped create education around this business has helped significantly. And now, annuities aren't viewed as a four-letter word anymore. They're just a tool in somebody's tool chest. So it's not a one size fits all proposition. And now I think it's, people are finally learning, like, okay, hey, this can be used for this subset of this person's nest egg, and it works great that way.
I like that you had kind of touched on actually what I was going to ask as my last question here was, what does an insurance licensed financial professional need to do in order to educate themselves about retirement options that their clients might ask about in order to make their clients feel more comfortable and confident in what the financial professional is presenting to them?
I mean, just like anything, I mean, they're out there on the island. They're their own business, their own boss, their own everything. So the onus is on them to get educated, right? Whether that's talking to someone like myself or one of your colleagues there at IAD, or one of the financial professionals we all work with together in this partnership of TruChoice and IAD, or going to a third party vendor, a nonprofit. And I'm just going to pull this up. The Alliance for Lifetime Income is probably the main nonprofit, and their website is tremendous. It's awesome. So for consumers to go there and educate themselves, or for the financial professional who is dipping their toe in this whole annuity life insurance world, that's maybe looking for some more education or whatnot, great resource. The Alliance for Lifetime Income, I can't say enough good things about them. Highly go check it out if you're listening to this.
Awesome. Awesome. Well, thank you so much for those resources as well, because I think that that is something that is really important to agents and brokers, is simply just education and finding reliable resources, because there's so much information that's out there on the internet these days, but not all of it is factual and correct, or just like even in general reliable. So being able to have those really reliable resources and being able to utilize your resources, like talking to you or talking to other colleagues at True Choice, or even talking to my colleagues here at IAD, like Bernard is absolutely amazing and is able to really help all of our brokers with just anything that they need assistance with, and he's got like an entire like lifetime of knowledge. So I in my opinion, like my greatest resource is our people. So making sure that as a broker you're leveraging your people and that you are seeking out the correct information and educating yourself, because the more educated that you are, the more passionate that you are, that you become about something, and the more passionate you are, the more that that is going to show to your clients, because people want to work with other people that are passionate and educated and
No,
know that you're not there just to make a sale. Like, you're there to truly show off the features and benefits of a product and the reason why it's going to benefit you. We always, I talk about all the time with, somebody's personal brand and their business brand is who you are, what you do, and how what you do provides value. But a lot of that goes into showing your products, what they are, what they do, and how they're going to provide value to their consumer. And so I think that kind of goes a lot into it.
Yeah, absolutely. And I'll say this as well, in this business, there's tons of industry meetings too. So if you're looking to get educated and or whatever the case is, find a meeting to go to. Like we have one that's open to all producers. It's called our Discover. It's at the end of September. And so there's that. I'm sure you guys probably will host some meetings or what have you. So making sure that you're available to get to, whether it's ours or, I think the Alliance for Lifetime Income might do some meetings. There's a wealth of knowledge out there. You just have to take the bull by the horns and go get it, and you got to want it. But yeah, so I would say look for different meetings as well, because one thing I have learned, and it goes beyond measure, is that financial professionals learn best from other financial professionals. It's great how much I know about this business, and I know about helping other brokers build their business and get more clients and so forth. At the end of the day, I don't do this. I'm not in the trenches like these advisors are. So no matter what I know, it doesn't go as far as an advisor meeting another advisor or financial professional at an industry meeting and sharing ideas, because that's going to go a lot further. I could share the same idea, but if they hear it from one of their peers, it's going to go a lot farther. It just is.
Yeah.
I've never had to sit down face to face with clients. I've never had to, try to sell them an annuity or anything like that. And so when we can get brokers together and help share ideas, it's invaluable.
That was actually, I'm glad that you touched on that, because that was actually something that I had shared with an agent yesterday. So she is in the Medicare space, and I was telling her that, some other ways for her to be able to learn and grow her business is to actually network with other industry professionals and other Medicare agents, because in general, we are in a world where we benefit more from each other and learning
Yeah.
things from one another than anywhere else. Like, so for example, I'm a freelance makeup artist, and I tell you, I learn so much more from my peers and like my other makeup artist friends, and we'll talk tips and tricks and like different products and stuff that help with like our clients, or why we like this or don't like that, and it helps each of us grow and learn different techniques and things. So it's the same thing for financial professionals. You will learn so much more from your peers than you will ever from watching a YouTube video. I mean, granted, yes, like utilize YouTube videos and utilize the information that's out there, but you are going to learn so much more from networking and
Yeah.
just sitting down and talking with other financial professionals. Yeah.
Yep. Agreed.
But Chris, thank you so much for joining me today on this episode of the Direct Insurance Podcast. I'm going to quickly kind of call out a couple of the key points that we talked about today, such as why consumers save for retirement, such as growing their wealth, saving for their kids' college education. We also talked about making sure that you have enough money in today's world in order to have a retirement income, because once the paycheck from your employer stops, you got to make sure you have some way to live. We also talked about the several different retirement options that are available to consumers in today's world. A couple of our favorites are, of course, fixed index annuities with income rider and benefits. We also have our long-term care insurance with hybrid options. And then we also have life insurance options such as IULs. And there are a couple more like traditional things that people are more comfortable with, which are bank CDs, but they just don't give you as much bang for your buck as these other options like the FIAs, the LTC hybrids, and the IULs. We also talked about the different risks associated with retirement, such as market risk, withdrawal risk, tax risk, social security, inflation, healthcare, longevity, and all of those things that, if you live longer, you need more money. And then we also talked about why annuities are such an attractive option for people in retirement in today's world, and how they can kind of not necessarily replace a retirement 401k plan, but it's a great option to kind of have alongside it. And we also talked about how financial professionals can also become stronger when they network with other financial professionals.
Yeah, you summed it up pretty nicely.
Yeah, there we go. Awesome. Awesome. Well, Chris, thank you again so much for joining me today. I loved having you as a guest today. You taught me so much. So I really hope that our audience, if you guys are out there listening, I hope that you guys got a lot of benefit from this episode as well.
Yeah, thank you for having me. I hope everybody learned and was able to take away at least a few nuggets. And it was just great being a part of this, and look forward to the next one.
Awesome. Awesome. So, Chris, if anybody out there listening wants to get in contact with you, how can they do that?
The best way would just call me direct. My direct number is 714-362-8957.
Awesome. Awesome. And if you are a financial professional out there, say you are a life insurance agent, an annuity agent, or a Medicare agent, and you are looking for an industry partner, we here at Insurance Advisors Direct would love to be considered. You can call us toll free, 1 800 381 0977. Or if you want to sniff us out first, you can always visit our website, www.iadbrokerage.com. And also make sure to follow us on social media. We are on Facebook, TikTok, YouTube, and LinkedIn. And if you want to watch this vodcast the day after the podcast airs, you can do so on the Insurance Advisors Direct YouTube channel. Again, Chris, thank you so much for joining me today. And I look forward to hopefully having you again.
Thanks, Kelsey. Take care, everyone.
Okay, bye bye.